What would you say are some of the tips that you would give founders to navigate raising for their business?
The first sort of rule of raising money, in my opinion, is if somebody offers you money, take it. I just leave that there.
Why would we want to have a double-sided variable where you have the value of the skins go up on a dollar value because they're more in demand, but then we also have the price of the token fluctuating on the back end? How does that make sense on the utility side of a sustainable business model?
Because that's exactly what we have in the physical world. Because of course your currency fluctuates on a daily basis. Although when you live in a country and don't exchange it all the time, you don't notice it.
Why would you say there's such an obsession with founders just wanting to put out tokens out there?
I think a lot of founders think that a token is a way to raise capital. But unfortunately, I think while that may be true in result, that should not be the purpose of a token.
Why would you say we're seeing this trend happening right now on the marketplace where memes are outperforming more logical investment vehicles like utility tokens?
Memecoins are UGC in the same way that a YouTube video is UGC. And so I think Memecoins can contribute to that as another vehicle for which you can broaden that tier of adoption.
You are the CEO of Animoca Brands.
I am.
Since our conversation with your colleague Yatsu, he's shared a stat with me that was mind-blowing, which is that the company had grown from a valuation of 10 million back in early 2018 to your top valuation to 5 billion around 2022. You've so far invested as part of your company in over 550 Web3 startups.
Hopefully.
And you've had some incredible partnerships and investments, counting Sandbox and of course Yuga Labs and the ApeCoin token. For you, for every company you invest in, your team and yourself have probably had conversations with hundreds of hours. So from what you've seen from the array of startups, what makes a successful Web3 startup that you look at in an industry that perhaps have yet to find product market fit? Where the idea of how does a token fit within a sustainable business model? How do you look at the landscape of all the startups and define what are the successful ones that have a shot and the ones that don't?
So there's no sort of one answer or right answer to this question. I think a lot of it depends on both the team is a combination of team and product, but also market. So I'll give you kind of a timeline. When we first started, investing quite actively in the Web3 space, or sort of during late 2019, 2020, pretty much every deal I saw for almost 2 years was the first mover in their space. Like somebody would come to me and they'd be like, I'm doing a Web3 first-person shooter game. I'm doing a Web3 art marketplace. And they were literally the first person who I'd ever met who had that idea. And a little DD proved, yep, they're the only ones doing it. So the checks were easy to write at that time because we all believe that there is a first mover advantage, particularly in certain kinds of vertical categories. That has changed now because obviously lots of categories have been filled already and it's getting more mature and more competitive. And gaming is a perfect example of that. So I think a lot of the things we look at are fundamental things that any investor or venture capitalist would look at. Team is really important, and team not just in the track record they have, but it's more about, it's similar to when you're hiring somebody. Yes, it matters where they worked before. You might pay more attention to them because they have, brand name employers on their CV or something like that. But it's really down to the relationship you form with them during the interview process. And the same thing is true, I find, with entrepreneurs. It's about getting to know that person and getting to understand how they will sort of respond to the challenges and the shifting sands of the marketplace and Web3 over time. Because the one thing that we can be sure of is that everything will change quite frequently. And so it's a lot about how those leaders and managers will adjust to the changes in their environment, because they may find that the product they set out to make, by the time they actually finish it, may have some measure of irrelevance. So are they able to pivot? Are they able to pivot their strategy midstream, so to speak? And how do they address those challenges?
Would you say that today, is it harder to be a founder than it was back in 2018-19. Back then, of course, most of the niches and industries were still blue oceans.
Yes.
But the tech stack was a lot harder and costly to build technology back then versus today. Would you say, when was a better market to build in?
So I think it's just a matter of different challenges. So back then, particularly in 2021, capital was very easily available. And so from that perspective, one major obstacle was easily solved because you could go out there with a business plan and raise capital for Web3 because it was the flavor of the moment. But I would say that actually building a product to find product market fit is actually easier today. But the trick is getting the money together to actually fund it. Because the funding environment is much tighter now. But as you said, the tech stack is more mature. When we first started making Web3 games back in 2018, we would literally have to build most of the components ourselves. We built on a new chain, so we would have to build a marketplace there. We would have to build a bridge to bridge it to another chain. All of these things, there were no off-the-shelf solutions for them, so we would have to architect them ourselves. And even things like, smart contract audits and stuff were not easily and widely available. So all of those things you can avail yourself of today as a founder and really focus your effort on a particular vertical. On the flip side, we feel like that's one of the reasons actually that we ended up starting a services component to our business, because we have had such a kind of long history in this industry. And I say that in quotes because that's like 7 years, right?
But dinosaurs.
Exactly. But it has given us sort of a breadth of experience across building lots of different parts of the tech stack. We built on lots of chains, we've built marketplaces, we've built all these kind of things. So at least we have kind of an understanding of the tools and what's available, and maybe, can be hopefully better informed in how to help our founders.
Why'd you say that it's easier to find product market fit today?
There's more market. And it's more mature. So there are, if you go out there today and you launch a great Web3 game on, Ethereum, there's a massive Ethereum community with lots of liquidity there available for you to tap into if they like your product. But there are also other communities. There's a massive Solana community out there, as we have seen with the Memecoin summer, let's call it. And so there are all these great communities with value there, who are eager and willing to find products and love Web3 and are early adopters by nature and want to try stuff out. So I think, for you to get to a certain level, to go out there and test something, find tens of thousands of users, actually that's not hard. But to get the next step beyond, then you really need to show that you can produce value.
That makes sense. Talking about value, there's an array of founders that I get to speak with through what I do in Web3. And one of the things that has really surprised me is the valuation that some of the companies, startups have before even having a product on the market or before even being profitable on the market.
Yep.
When you look at these startups beyond the team and beyond perhaps the proprietary tech that they have, do you also use the traditional financial instruments like EBITDA, revenue after expenses, before taxes? Do you look at that as much as in traditional finance, or is that part of the industry a little bit more overlooked because we are betting on the future of that team?
So, valuation is tough because one of those things that's funny is that people will always comment that things are overvalued or undervalued. And yet at the same time, as sort of believers in economics, we will all say that the market is correct at all times as well, because it's a free market.
Correct.
So there's kind of a disconnect there. But I think the challenge that we often have in Web3 is that we are not yet at the stage of maturity where we have agreed upon metrics across the industry by which to judge, a valuable customer or a successful product market fit or penetration, in a market. For example, in mobile gaming, typically we use daily active users or monthly active users as a, sort of finger in the air indicator of whether a product has traction or whether your user acquisition has been successful. But yet in Web3, those don't necessarily have value because the nature of the user is so different, right? The user tends to be much more high value and have a much higher rate of retention. We see in our games rates of retention where, you can see day 30 retention of upwards of 60%. And yet, if I was doing a Web2 mobile game, I would be lucky to have more than 3% after 7 days, right? By day 30, I expect 0, frankly. But it's a different business model. So you can't measure them like that. DAU number is not apples to apples remotely. So I think often I encourage people thinking about valuation to think about much more traditional metrics, which is the business making revenue? Does it make a profit? Are they able to cover their overheads? These are just sort of the fundamentals of sustainability, so to speak. And then if you dig deeper, you can start to think about things like, are they able to measure what their customer acquisition cost is? Do they have some type of novel sort of Web3 enabled way in which they are acquiring customers that gives them a nice flywheel where they can bring in customers at lower cost than they monetize them for? And so you really have to dig into the kind of the tokenomics and the metrics of the individual business itself.
That's interesting. That's fascinating. Would you say that just being a Web3 startup gives a multiplier to your valuation as a company? And the reason I asked this is just yesterday I was speaking with a partner of ours who are currently in the process of raising from one of the top 5 VCs in Web3. And the valuation he told me they're raising at, I was like, wow, like how does it feel to be the founder of a multi 8-figure Web3 startup? And I was looking at this, I was like, these valuation for someone to raise is let's say 50 million, for example. A Web2 company that is valued at 50 million, that's an established business that has a sustainable business model, that is a recurring revenue. That's a healthy business. But in Web3, the same valuation is oftentimes a company that's still trying to roll out products, still trying to find the next big breakthrough in their industry. So how do you justify these inflated valuations?
So I think the way to look at valuation is a relative metric. I don't think we should focus too much on valuation as an absolute sort of dollar equivalent number, because valuation in Web3 often, first you have to separate, are you talking about equity value or are you talking about token value? Because those are different instruments, and investors who invest in each of those instruments will think about valuation in different ways. Equity investors are typically much more like the Web2 investors that you were talking about, where they will look at a lot of traditional P&L metrics and make a judgment that way, because at the end of the day, valuation only matters in terms of monetary gain based on your ability to exit at that valuation, because otherwise it's just a number in time, right? And we've all been there where valuations go up and they go down and they make you feel good. And, it's the same with punting on Memecoins, right? It's an emotional roller coaster. And so I think that if you're looking at token valuations, that's a different story, because in the area of token valuations, you do have the potential to have a token go live and be public and have a public valuation in very short order, because it's possible to launch a token and have it be public, within the course of months or a year. And so as a result, there can be public market validation of a valuation. So I think sometimes we see token prices in the private markets escalate because there is an anticipation of what the public market value of that might be. And so therefore, people are discounting back from that.
Interesting.
Whether that's sound investing strategy or not, that's a separate issue though. But I think that's how they're arriving at some of those numbers. And if you think about pricing I think is really just a way in which to index the relative splitting of the pie. Because when you think about, and I'm speaking about tokens, when you think about creating tokenomics, everybody's got that classic tokenomics pie, how much goes to the founders and the KOLs and the investors and what have you. But the attribution of that pie is very important, and it's very important to get that right to have a healthy and sustainable project. And so then once you allocate the bits of that relative pie, you're essentially just working back from an expected total market cap. And so you derive some number. And that number may look out of sync because you're working from a public market back in hopes that you will achieve that in a public market. My personal view is valuation is always better lower than higher, because as a founder, I think that you should always be thinking about, number one, securing capital for your business as it needs it. And you should always be thinking about who you can bring on as strategic investors in your business and partners to the business to help it grow, and not be concerned about valuation. If you have to lower your valuation to bring on a good strategic partner, I would do it every day of the week.
Got it. Before we talk about the founder's perspective to investing, it's important to understand the investor's perspective. Mm-hmm. How does their business model work? Mm-hmm. So we can, as founders, create products that is appealing to these investors. Would you say something that's appealing about Web3 as an investor is you have the ability to, let's call it double dip, where you have valuation into the business that you can free ride for the next decade, but you also have the ability to have shorter cash cycles through the token, which often take 12, 24, 36 months to become liquid. Is that one of the appealing parts of investing in Web3 startups?
So I think, yes, short answer. But I think also what it does is it changes your risk appetite. So if you believe, what you will see is a lot of Web3 native investors are focused specifically on tokens rather than equity, because what they're doing is they're substituting token liquidity risk for IPO timeline risk. So if you're managing a VC fund, typically you will have a 5-year investment time cycle. Maybe you can add a couple of years onto that, and then you will have a harvesting cycle. So really your expectation is, even if if this is the first investment of your fund, you're expecting within 8 years to be able to get your money back out and have a return. And so then the VCs ask themselves, do I expect that this company is going to be able to grow to a point where it can be a public company in the public markets, IPO, and I can then exit my position post-IPO all within that time frame?
Right.
And what if you happen to meet the VC in year 4 of his fund or her fund? Then maybe that timeline is shortened just because, they have an issue with the life of their fund, right? And so tokens are slightly different because you can shorten that horizon and see that liquidity event potentially over the horizon. Then they may be willing to take more of a risk because they're like, oh, well, I can try this, but I'll know within 24 months whether this is working or not. And I'm not going to have to provide additional resources. I'm not going to have to provide portfolio support and all this stuff, because it either works or it doesn't work. And I'll know very quickly.
Understood. When it comes to the founders, what would you say are some of the tips that you would give founders to navigate raising for their business?
So I'd say it's very similar to sales. If you've ever done telesales, it's, as we call it, dialing for dollars. It's a matter of just pitching. And like anything else, you will get better at it over time, but also listening, and listening to the feedback that you get from potential investors, and understanding what it is about your business, the things that they like, the things that they don't like, because it may be, you may want to take on board some of the commentary you receive and rethink, some of your roadmap and what you have planned for your business. Or you might not. You might disagree. You might think, the investors don't understand and only you do. And there are exceptional stories of founders who don't listen to anybody and yet produce amazing products. Everybody always holds up Steve Jobs as an example of that.
Correct.
But I think the hardest part is actually getting your foot in the door. And so getting your foot in the door is a matter of just working every network possible that you can think of. I think it's why, frankly, Web3 events are so popular, because in-person events are an opportunity to connect live with other founders. I think one thing I can say as somebody who receives a lot of solicitations, warm introductions are definitely much more well received. I have so many people who, seek us as an investor, that like just tons of cold calls, basically, that most of them go ignored. I just couldn't possibly respond to every email I receive. But when somebody else introduces it, whether it's a friend or a fellow VC in the industry or another founder in our portfolio, they say, hey, I know this guy or this woman, and they have this amazing startup. They're really dedicated. You should check it out. Of course, I take a look at it because it comes with a warm introduction from somebody I trust. So try to work your network and see how you can get those warm introductions. And those can come from strange places. They can come from family members. They can come from, your friend down the street. They can come from literally anywhere. And so I think the most important thing is to just always kind of have your feelers out and be open to kind of that serendipity.
Interesting. So be open to that serendipity. Oftentimes, based on my experience, what the investors tend to have leverage in the conversation, which oftentimes create a hostile environment between the founder and the investors. As someone seeking support from these investors, how much would you recommend going for seeking those strategic partners that can not only come in and inject liquidity in your business, but also can open up doors on the other side, versus just keeping more, if you will, shares within your company and only getting liquidity?
So I would say a few things on this. First, I think that, like we were talking about earlier, as an investor, when I look for founders, it's kind of like almost like a recruitment process. I mean, again, we can go to a different analogy, which is dating, of course, because it's actually a two-way street as well. I think the founders and the entrepreneurs should also be trying on the investors for size and asking themselves, are these the right investors? The first sort of rule of raising money, in my opinion, is if somebody offers you money, take it. I just leave that there.
Okay.
There's no qualifier to that.
Okay.
I think that whenever you have the opportunity to take capital, if you're an early stage founder, you should take it, because capital is very often, more often than not available. And so therefore, when the opportunity comes, you should take it. And don't haggle too much over valuation and all those things. But then again, I would have taken, the $1 billion for Facebook that Mark Zuckerberg famously turned down, and then he went public. But, I think that was probably still not a bad idea, in fairness. But I think also you should be thinking so rule number one, take the money if it's there. But number two, you also have to work with these investors. So really get to know them as people and decide for yourself if you feel like this is somebody that shares your vision for the business and somebody who you think you'll be able to call for help. Don't be distracted by a fancy pedigree or brand name, right? Because it's like everything in the world, right? Some things with brand names have companies and people who reflect those brands, and some don't. Some just take advantage of brand equity. And I think investors are the same. So you need to find individuals at those firms who you think are going to be your champions, because you are not just getting capital from them. You hopefully will get more from them. You want to get their help with things. You want to get, at a minimum, introductions to people in their network that you might need, but also maybe mentoring or other things that can help you to grow your business. You want as many advocates in the world for your business as possible. And
correct,
the investor is going to be more aligned with you than anybody else, apart from your employees, in helping you to get to that goal.
I'm very happy you mentioned the word distracting, because there's something fascinating happening right now as we speak on the marketplace. Mm-hmm. We've seen Murad, very famous content creator, talk about the meme coin super cycle. Mm-hmm. How memes are dominating the volume attention economy and just every metric that you can look at when looking at how assets are performing on the marketplace. Mm-hmm. In a free market, it's a game of competition. If someone is investing in meme coins, that's liquidity that is not being injected in utility coins, oftentimes that are backed by investors. And as founders, especially the ones that are trying to build real products and services, they look at what's happening and they're like, man, am I really being outcompeted by these meme coins? Why would you say we're seeing this trend happening right now in the marketplace where memes are outperforming more logical investment vehicles like utility tokens?
So, glad you hit on this. Memecoin Jesus is one of my favorite topics. So I think the important thing is to take something like the phenomenon of meme coins and I think figure out how to orient it in space, if you will. Where does it fit in as a component of our wider industry? Because I think that meme coins are not, they're a thing. They're not a good thing or a bad thing. They're just a thing. And I always my favorite analogy for meme coins, which actually I didn't make up, somebody else smarter than me did, but it's essentially user-generated content. Meme coins are UGC in the same way that a YouTube video is UGC, right? You can upload anything you want to YouTube, and the difference between me and Mr. Beast is $100 million of production value and a professional team, right? And the results will bear witness to that. And so I think when we think about meme coins as UGC, it's interesting because if we want to sort of torture that YouTube analogy, it's kind of like imagining what is the YouTube strategy for people who have so-called traditional television shows and feature films. They all tend to have nowadays a YouTube strategy of how they use YouTube for user acquisition to get people to watch things on Netflix or in the cinema or elsewhere. Just in the same way that, I was chatting with a member of the press recently and saying, I thought all people who make games in Web3 should have a Telegram strategy, because I think that's a great user acquisition channel, even if it's not your primary game venue, to engage users on Telegram to bring them into maybe a game that might be on PC or elsewhere. And so I think meme coins can serve exactly the same purpose. And now we see that actually meme coin communities, as they evolve, some of the more sticky ones, are launching their own NFT collections.
Correct.
And so I think we see a reversing of a cycle where NFT collections were launching tokens previously, but it's a way to galvanize additional products and services around a community that has decided to stay together for a reason. And so just like any other UGC, meme coins are essentially, this spraying of content against the wall, and some of it sticks and forms communities. And those communities can then stay together and decide, hey, we want to do more here. Not just the meme coin's not enough. Let's have NFTs. Maybe we'll have some meetups in real life. And then maybe, and then next thing you know it, they have a DAO and they're voting on stuff.
Right. So from what I understand from what you said is that meme coins are a superior marketing vehicle because they allow the part of them, UGC is engineered within the fabric of meme coins.
Yes.
In practice, how would you invite utility founders, whether launching an NFT token, how would you invite them to use that lesson or theory into their existing model?
So it's a way, I think it's another kind of community building tool or weapon, if you will, that you can have in your arsenal. So think about one of the analogies we like to use in our business when we think about creating engaging relationships with communities, we love to use the Ferrari analogy because Ferrari has done a fantastic job of creating a way to create a luxurious brand with very broad appeal. Because frankly, there are so many people in the world who love Ferraris and love the brand of Ferrari, but actually very few people own one. Right? And so you'd think, well, because so many few people own them, how do people get this relationship with this particular brand? Because they actually have a tiered structure. You can own a car, but you can also own Ferrari luggage. You can own Ferrari helmets. You can go and watch the Formula One team. You can buy a keychain. There are many, many tiers of membership to becoming a member in the Ferrari brand club. And that way they can broaden their appeal very, very widely. They do collaborations. Maybe you buy a pair of, I think it's Puma trainers that are cross-branded with Ferrari, right? Which is not that dissimilar from, having a Bored Ape Yacht Club and Bathing Ape collaboration, for example, because it's about cross-pollinating communities and growing your brand by establishing those network effects between different communities. And so I think Memecoins can contribute to that as another vehicle for which you can broaden that tier of adoption. So like if you look at our Mochaverse community, we started out with an NFT collection, but it's limited. There will only be 8,888 people who will hold those NFTs. So we came up with another tier, which is our decentralized ID system. And that way we can broaden it so that lots and lots of people can then join the decentralized ID system.
The Mocha ID.
And then we launched a token, because if you can't afford the NFT, that's okay, right? Because you can buy tokens, and that allows you to also participate in the network effects of our network. And this is not novel to us. Lots of people in Web3 do this, but it's a way to figure out, how do I engage with customers and clients and members and partners at different tiers of engagement by maybe monetary value or utility, but figure out a way to have a little bit of a something for everybody.
Interesting. So looking at the marketing funnel of Animoca, for instance, the very top of funnel are the Mocha tokens. Mm-hmm. The middle of the funnel are the Mocha IDs. Mm-hmm. And then bottom of funnel, that's where the NFTs would be.
Yes.
That's your super fan community.
Yes.
Was that a thoughtful process that was engineered and designed before even launching the NFT? Was that always the objective?
It was. Yeah.
How far away do you plan your strategies?
So I think we always try to look out at least a year if we can.
Yeah.
But in Web3, it's very challenging. And we know that stuff will always change. If you look at even a Mochaverse deck from a year ago, many things in there we didn't end up doing, and many new things, which are actually things we're really proud of, were not part of the original roadmap. It's constantly changing. So the challenge is to be able to actually execute those pivots. That's actually much harder, to be that nimble. And that's something that I've observed a lot of Web 2 game companies coming into Web 3 have struggled with, because the way game developers have historically worked in Web 2, especially people who develop for console or PC, they go and raise money and then they go build a game for 2 years and then they come back. And you can't do that in Web 3. Correct. Because whatever you end up with in 2 years will not be fit for whatever the market looks like then, right?
Okay, got it. Why would you say there's such an obsession with founders wanting to launch tokens? Last week, I was speaking with a founder that have an incredible marketing tool that gives you in-depth analytics data for your marketing campaigns with creators and KOLs. Mm-hmm. And then halfway through the conversation, that founder mentions to me, he's like, "Oh yeah, Leon, we just launched our token." I look at the guy and I'm like, "Why did you guys need a token? Well, what was the thought process behind? How does that fit within your MVP?" Mm-hmm. Why would you say there's such an obsession with founders just wanting to put out tokens out there? I'll pause here because I'm going to stack my question later.
Okay.
Yeah.
So 2 points on that. One, I think a lot of founders think that a token is a way to raise capital. But unfortunately, I think while that may be true in result, that should not be the purpose of a token, because a token is about harnessing network effects and distributing those network effects in your community. So I think one of the things that, like, where I really agree with Murad, the Memecoin guy, is I really agree that if you have a community that's quite decentralized, where you have very broad ownership, I think that token will do better over time, because I do think that increased decentralization basically gives you more people who have a stake in the network, more people who have a stake in the outcome that this thing is successful. And so therefore that is inherently good for whatever the fate of the product is, or the project is. Whereas if you have very high concentration of ownership, then frankly, you only have a few people who are interested in the outcome. So I think that's one reason why I think tokens are generally a net positive in projects. I think anytime you have a consumer project, it would be an exceptional case where a token would not be, I think, an improvement on the situation, because it's a great way to reward and retain users. In B2B projects, then I think a token has to be thoughtfully created, because sometimes it may just be a mechanism for what would otherwise be an enterprise SaaS business.
Correct.
And so the question is whether the infrastructure of a token provides, a tangible improvement. In consumer applications where tokens can be publicly listed and publicly traded and you can transfer value between networks, that's kind of a different story.
So beyond building culture, which is what Memecoins have proved to do very well, would you say that the only reason why someone would launch a token if there's the clear improvement in user experience on the back end through the usage and liquidity of token versus going with the traditional credit cards, stable fiat payments?
So I think that if I think of consumer applications, I think there is always a reason to launch a token because a token gives you optionality. Because at its heart, a token can function simply as a medium of exchange in your application. So I use an example to make this more clear. Like if I'm developing a game, you can use a token as an in-game currency. So you can buy stuff in the game. But you can also then use a token for things like governance in the game. Say your game has very passionate players and they organize into guilds and teams, and then you can decide, okay, well, if you hold a certain number of tokens, then we'll give you, a certain tier of membership that entitles you to vote on stuff and to really, have decision-making power as part of the community into what new content we develop for the game. And so there is that optionality because tokens are programmable at the end of the day. The other thing that's interesting is if you think about them as proofs of community participation, then I think this whole idea of being able to interoperate them with other ecosystems is very exciting, because what it means is that, we have a terrible word in our industry for something that's actually a wonderful tool, which is the vampire attack.
But a wonderful tool. Okay.
Because a vampire attack is basically just cross-marketing, right? Because essentially what that means is that you have an existing community who all hold your token, and I can say, hey, I have a cool project here. I'm now accepting Leon's tokens, and if you bring them over here, I'll give you not just 1, I'll give you 1.5 when you come here. And so you could argue I've vampire attacked. But what I've actually done is I've actually turned your token into a superpower token because it's now worth 1 and 1.5, depending on where you want to use it. So I've actually created more utility for your token. I've given your token holders something free and made your token more powerful. And so vampire attack is actually kind of a false narrative, I think, from this zero-sum game world of Web2, because what I've done is actually I've done you a favor. But at the same time, I've potentially bootstrapped my community by bringing some of the liquidity from your community into my community. So in that sort of scenario, I actually view it as a win-win.
Blur was an example of a vampire attack on OpenSea. What other examples do you have of successful ones?
So I think what I would suggest is any kind of interoperability is essentially, you could call it a vampire attack, right? So Pixels, a game which has been quite successful in Web3, one of our portfolio companies. The thing I loved about it from day one was the fact that it offered huge, for the time, interoperability, because you could take any NFT and use it as your avatar in the game. It didn't matter what your NFT looked like. And it was a great way to onboard other communities from around Web3, because essentially they said, okay, we have this game Pixels, but if you have a Bored Ape, if you have a CryptoPunk, if you have a piece of NFT artwork, you can come to our game and use it as your avatar and play, right? So essentially they were going out to other communities and offering utility and onboarding users from other communities. So if you want to take a really pessimistic view of things, you could argue, well, they're taking attention away because the one thing in the world we don't have an abundance of is time, right? But they're also offering utility, because now, guess what? If you own a Punk or a Bored Ape, you can play it in Pixels. So they also gave benefit to those communities. And it's that reciprocity of benefit that I think is the superpower of why we're all here in Web3. Because actually, it's a way that we can elevate all of the products in our industry because we're sharing and collaborating. So fundamentally, it goes back to this idea of globalization, right? It's about this idea that we're bringing down, like bringing down tariff barriers between nations and offering free trade, rather than just deciding, well, I'm going to be North Korea.
I got it. I'd like to spend a little bit more time on the point of the business model behind tokens. So I'm looking at it from two perspectives right now. There's the community perspective. If you've read the book, the Read, Write, Own, it talks about the concept where the token is an innovation because it allows to kickstart the cold start problem and incentivize early adopters in a network over the long term for an asset that gains in value. So we understand that. Everyone who's watching this understands that. Now, when it comes to a utility token, let's say, for example, we have a Web3 game that resells skins on the marketplace. Why would we want to have a double-sided variable where you have the value of the skins go up on a dollar value because they're more in demand, but then we also have the price of the token fluctuating on the back end? So it creates two layers of variables. How does that make sense on the utility side of a sustainable business model?
Because that's exactly what we have in the physical world.
Okay.
Because of course your currency fluctuates on a daily basis. Although when you live in a country and don't exchange it all the time, you don't notice it because you're only operating in a one currency environment. We in Web3 tend to think more laterally because most of us hold more than one cryptocurrency. But I think the same thing holds true, that you have two variables. Traditionally, again, I'm putting my gaming hat on because it's a sort of a simple economic example. Traditionally, games have always been hyperinflationary, right? There is no limit to the number of in-game currencies, tokens, let's call it,
Correct,
that we issue, and no limit to the number of items because consumers just consume. It's a one-way street. And so the art of building a good tokenomic model is to figure out how in a fixed supply environment you can make sure that everything circulates efficiently and doesn't create any abnormalities. Because the idea is to create a tokenomic model where you have sustenance and longevity, not, that the token value goes up or that it goes down. Trying to manipulate prices is a fool's errand, frankly, because everybody's goal should be longevity and sustainability, just like it is when you run a country and have a government. You want things to just be steady, and then the market will take care of itself. And so I think that's how we approach typically our tokenomic designs as well.
Okay, so a big part of it is how the token is designed at its core.
100%. And it's very hard. I'm not going to lie there. We struggled for the first couple of years that we were in this industry in really trying to hone our tokenomics chops to figure out how to create really sustainable models. And there have been a lot of learnings along the way. One of the common mistakes we made at the beginning was when you design things, you assume that people are rational and act according to incentives, right? So if I have two paths and one path will make them more money, then I assume they will choose this path. But actually, people are not rational. People sell stuff at a loss when they're angry. People buy stuff when the price is too high because they're emotional.
Interesting.
So you need to actually have colleagues, and now I can say we have lots of colleagues who come from, backgrounds of things like physics and material sciences because they're accustomed to working with very complex multivariable systems.
Right.
Because the area of tokenomics is not just as simple as putting together a pie chart and deciding who gets what. It's a very complicated science.
On the science of tokenomics, is it like the laws of gravity, where once you find all the variables, it's a one size fits all? Or is every game that you design has its own laws of physics with its own variables?
I'd say the physics are the same, but it's up to the number of variables, because often in a project, the number of variables are up to you to create and to decide what are the levers of your business that help to satisfy customers or incentivize customers. And you're also often trying to juggle two interconnected worlds, because you may have the operating product, let's call it. So in this case, we're talking about a game, so the operating game, but you may also have a token that trades live in a marketplace, and if your game is based upon having a steady token price, you need to decide then, so what are my tokenomics around my token in live marketplaces that are going to keep it steady?
Wow.
And not subject to exogenous shocks, because that will then tip my game economy if my token price is volatile.
That's advanced.
Yes.
Yeah, I can imagine. Throughout one of the podcast interviews that you had with one of my good friends and colleague, Andrew Forte, you mentioned that the prices of Web2 gaming, the acquisition cost of users for Web2 gaming has skyrocketed over the last decade.
Yes.
And especially when Apple made it harder to target users through their iOS update a couple of years back. I was a media buyer back then in Web2, and the shock was felt overnight. CPM costs skyrocketed overnight. How do you see Web3 as a solution to the increased cost of acquiring users and the decreased LTV that these users have?
Sure. So I think first we have to talk about what is the business model of Web2 user acquisition. So Web2 user acquisition typically, and I think honestly, our background in mobile gaming as historically a mobile gaming studio gives us a particular lens on this, because mobile gaming is one of the biggest spenders of user acquisition around. The industry spends $100 billion a year on user acquisition. And one of the biggest challenges that we have always had is that we were beholden to two monopoly platforms of sorts, right? Apple and Google for the most part. And the hardest part is that we're essentially acquiring users through those platforms, but the users don't stick around because our Web2 applications don't have high retention. And so often we're paying for the same users over and over to reinsert them in the top of the funnel every time. And they come through the funnel, and then eventually 2% of them stick around and pay for stuff. And that subsidizes the other 98% who don't pay for stuff. And then we rinse and repeat. And so we're always going out there to other big networks, like Facebook, for example, acquiring users, putting them back into the funnel. We don't have a direct to customer relationship, right? And I think we're not the only ones that complain about this. Pretty much everybody in e-commerce complains about the fact that they don't have direct to customer relationships anymore. This includes, luxury consumer brands, you name it. And this is something that I think Web3 can really help us to regain control of. Because once you start to involve tokens, which are easily traceable and can be also transmitted in terms of value from company to user or company to company, et cetera, peer to peer, we have the ability to track all of these things and create those direct relationships. And so I think one of the things that we see in how user acquisition is changing in Web3 goes back to our sort of tongue-in-cheek discussion about vampire attacks. Because if I think about how I acquire users in Web3, I acquire them by often creating utility for other Web3 communities, right? If I decide that I'm going to create a game and and my game, has a token value of 1, but I'm going to give a value of 1.5 to anybody who comes and spends Dogecoin in my game. All of a sudden, I have made Dogecoin very attractive to be used in my game. They get extra value there. So there's a community around the world of millions and millions of people who hold Dogecoin who then can look at my game and say, hey, I'm going to try that game out. That's cool. I'm getting a discount basically for going and trying that game. And so by offering that utility, I can do something which has very little cost to me, but can help to onboard users from that community because I'm offering utility to that community. Now that analogy holds true also if I say, oh, free digital merch if you show up in my game and bring a Bored Ape, right? Because maybe I want to onboard that community, and maybe I've decided that that community is a early adopter, higher spending, more loyal community because of what I've observed in the demographics of that community.
Correct.
So maybe I make my offer even more tantalizing because I know there's a limited number in that community, and so therefore I can estimate what my cost of that activation will be.
That's only possible with Web3.
Yes. And the thing is, I don't need to go to Yuga to do that. I don't need their permission. I can just say, hey, I've got this thing that's here, come and try it out. And the thing is, at the end of the day, the Yuga team, because they're native in Web3, understand that that's cool and that's great for their community. So actually they would be supportive anyway.
That's beautiful. That's incredible. We've all seen the 1 hour community member. They come in they buy into a token, they check out the Discord.
Airdrop farmer.
The airdrop farmer. 1 hour later, they're funding the project.
Yes.
There's a narrative circulating right now in Web3, which is a community of mercenaries that are only here for the token. Maybe they're playing your game, but they're only here for the token. And once that drops, they're out.
Yep.
Is that really a community?
Yep. Okay. So totally understand what you're saying. And it's actually one of the things that precipitated us creating the Mocha ID. So the idea behind the Mocha ID was reputation is important. And what we wanted to do was figure out how we could create some type of reputation system, starting with the game community, but then broadening it out beyond just gaming into the broader Web3 community, so that we could identify valuable users. Valuable users because they have proven themselves to be loyal. They have proven themselves to be, longer term holders of tokens, if that's the metric you want to use. Their behaviors have demonstrated that these are the people that we should be focused on incentivizing and rewarding. And make that knowledge and data public, because then it's not just us who recognizes them, right? Other people can recognize them as well. And that makes this much more valuable for them to have this reputation, because if they can go around and show that they're not 1 hour community members, then everybody will want them as part of the community, because they're like, ooh, I want people like that. They're loyal customers.
That's very interesting.
And I'm also maybe willing to pay more, or maybe I'll give them some free airdrops because I know that that's the kind of person I want in my community.
That's very interesting. How many Mocha IDs have been minted so far?
About 2 million.
2 million?
Yeah.
Okay. And the way it works is if the Mocha ID is attached to a wallet, all of a sudden you have the ability to track that wallet or have a score for that specific wallet.
Correct.
In terms of holding time, average wallet size.
Yes. And we also try to make it fun. So essentially we've gamified it a little bit so that we offer activations with partners. You can earn points, realm points, you can earn Mocha tokens, etc., from participating in those activations, because we want to, if we recommend something from one of our partners, we also want to reward you from participating in that. It's a little bit like, here's the Amazon coupon for participating in a survey. You're doing us a favor by trying something out, so we should reward you for doing that.
From an advertiser's perspective, can advertisers target Mocha ID specific quality of users, or is that a product that needs to be unlocked through the Mochaverse ecosystem?
So the answer is yes, but it's a work in progress in terms of how fine the tooling is on that. That's something that we're continually trying to improve.
Because that would be a great acquisition channel.
Yep, we hope so.
Yeah, that's very, very interesting. Robby, it's been incredible. I would love to hear your final thoughts that you have for founders that aspire to one day become a thought leader, founder, builder like yourself. What would you say are some of the tips that you have for them?
I think that first you have to decide if the Web3 industry and building software here is for you. I think that one of the things that I love about Web3 is the broader community of people in Web3. I find there's a lot of positivity. I really do feel like we're undergoing a generational change in the way that we use the internet. So I think that there's tremendous opportunity, but not just financial or business opportunity, but also frankly opportunity to make a good positive change in the world through the kinds of products that we create. Not just being able to save more money on our shopping, but actually things like democratizing access to financial products and things like that, and more financial inclusion around the world, which I think is amazing. And so if you think that that's for you, then I very much encourage people to come and join it. I think they will find that they're welcomed by the community. But you need to be prepared to have an open and sharing mindset, because the people who do best in Web3 are the ones who are more open, more transparent, and more willing to share, because we're all part of a big community and a big family. And I think you see some of that attitude just reflected in our online conversations. And so I think if you want to come and be part of the community, I really encourage people to do so.
About preparedness, where if history repeats itself, we're on the cusp of a bull market. When becomes the bad time to build, in the sense where you've already missed the train and now you all of a sudden have to wait for the next bear market and then bull cycle?
So I think the important thing is to try to ignore it altogether. You need to, if you're a founder, you're going to be employing people and you have a lot of responsibility because you have people's salaries and their lives, are your responsibility. So you need to make sure that you are equipped regardless of what the market does. You have to have enough runway. As we saw at the end of 2022, a lot of people found that when the market dried up for new fundraising, they had not planned to have enough runway to see them through 2023. So you need to be prudent, because now, at least even for the younger people who maybe have had their first jobs in Web3 and crypto, have now at least seen one market cycle to see that these things happen. So you need to be prepared and take it seriously. But I do think that if you have a, call it 5-year to 10-year time horizon in this industry, there's nowhere that we're going but up. It's kind of a no-brainer, right? And everything that happens in the middle are just sort of inflection points and volatility. But, you take any chart in our industry of tokens and you zoom out and the picture is always pretty.
Beautiful. What a final note. Robby, it's been a pleasure.
Thank you very much. Great to meet you.